Welcome. I'm Rich Carroll from Home Team Inspections, and we're a proud sponsor of today's market update with Dr. Brad O'Connor. Brad O'Connor is the chief economist for Florida REALTORS, the state's largest trade association with over 195,000 members. As the head of the research department at Florida REALTORS, he oversees the production of the association's widely cited monthly housing market statistics, as well as numerous other economic and statistical research projects. His commentary on Florida's real estate markets regularly appears in major daily newspapers around the state and has been featured in many national publications, including Bloomberg, Businessweek, The Wall Street Journal, and The Washington Post. Dr. O'Connor received his bachelor's degree in economics from The Ohio State University and earned his master's and doctoral degrees in economics from Florida State University, where his academic research chiefly involved the impacts of land use regulations on housing markets. Prior to joining Florida REALTORS, Dr. O'Connor served as the economic and statistical consultant for the Walt Disney Company in Orlando. Please welcome Dr. O'Connor.
Hi, everybody. Sorry, got off on the wrong foot there. Hello, now you can see me. Thank you very much for that introduction. I've got nice little presentation put together for you guys just to give you an update on the Florida housing market, and also we'll touch specifically in the Sarasota Manatee area. As I always say to groups from your parts, I grew up in Ohio, but my grandparents, since the time I was born, were Bradenton residents. So one of my favorite things to do, and a lot of my favorite childhood memories involve flying down to Bradenton to get out of the cold and see my grandparents. So I've got a lot more familiarity with the Sarasota Bradenton area than a lot of parts of the state. So always glad to talk to you guys, and hope everyone's doing well down there. I'm gonna get my slideshow up and running here. And just bear with me. There we go. Okay. Let's see if I can get on the first slide here. All right, so you should be able to see my opening screen here. If you're not really familiar with our statistics, my group was formed in 2011 by the Florida REALTORS Board of Directors, and our mission was to, after the housing crisis, the Realtor brand was taking a lot of hits from media and the public, even though we weren't responsible for the mortgage crisis. People were looking for people to blame, and so through no fault of our own, the industry's credibility sustained some damage. So one of the things that Florida REALTORS wanted to do was to set up a bona fide research department that would put out accurate and dependable statistics that would ensure that the association and the brand and all of you who wear the R had their credibility restored, and we could show that we're serious about what we do, and so that's what we did. And since then, my team and I have been producing statistics every month. We put out a statewide Florida report, and we work in partnership with your association and all the other local associations in the state. They provide us MLS feeds, and we're able to get a full state feed. So we have complete housing market statistics for the state of Florida out of all the MLSs. So in reciprocation for us letting us borrow your data, we provide all the local associations with local area reports too. That you can usually access through your local association, or you can also get them off the Florida REALTORS website if you log in. So I'll be running through a bunch of the statistics we monitor and that the media usually reports on each month. and just kind of walking you through what a year it's been so far, because it's been literally a year of ups and downs, and it's worth reviewing a little bit before I get into my outlook for where we go from here. So new pending sales is our measure of how many how many homes went under contract, how many homes went into a pending or contingent status during each month. And we included in this number are condos, townhouses, and single family. And you can see that it's been pretty consistent from year to year. In 2017, we had a little dip in September because of Hurricane Irma, but we hopped right back to where we usually are. But 2020, if you look in the top left corner of this chart, you can see the first 2 months of 2020 were actually much higher activity than normal. I had been hearing just anecdotally from members like you and all across the state that the winter buying season had started so early at the end of last year. And so we saw a lot of activity in even November and December, more so than we usually do. So coming into this year, things looked really great. But of course, at the end of February, I think it started to become apparent to a lot of people, a lot of business leaders, people invested in the stock market, that the coronavirus wasn't just a far off story of something going on the other side of the world, and that it was probably going to come here. So it really didn't take long after that for all of us to start getting used to new terminology like social distancing and all the other stuff we had to adjust to. And as a result, all across the state, new pending sales in the first week of February, or first week of March, really plummeted. And that was really the first statistic we saw. We started looking at weekly statistics at that point because we needed to see in real time what was happening to the market. That was the first thing we saw go. And not long thereafter, we started to see a lot of withdrawn listings in the MLSs as well. But new pending sales, just, anyone who was about to sign a contract just hopped onto the fence and out of the market for a while. So you can see that in our March and April numbers for new pending sales. We had a just catastrophic 2-month decline there, and it worsened throughout March and really bottomed out at the beginning of April. We actually started to see a little bit of improvement about mid-April in terms of new pending sales, where they were still bad, but they were at least getting a little bit better relative to where they usually are. So by May, in fact, we were surprised that at the end of May, we had actually pretty much matched our number of new pending sales the previous year. But the question now was, okay, so we're kind of back to where we were, but we've basically lost the spring buying season. This is the biggest season, overall for the state. Are we going to be able to make that up? And it turns out over the last 4 months through September, we have made that up and then some. So it's been it's been a surprisingly positive year so far in terms of home sales, considering how we started and what we thought might happen early on. I've put here some of the new pending sales statistics for your market area, Sarasota and Manatee counties. Single family home stats on the left, condo and townhouses on the right. The number of contracts in the first columns, and then the second columns are percent change year over year. If you don't often work with real estate statistics like this, we usually like to talk about changes in our metrics in terms of year over year instead of month to month. And the reason for that, as you're well aware, is that our real estate cycle is very seasonal. So comparing sales 1 month to the next doesn't always make sense if you're going into what is usually a less busy time of the year. So it's better to compare the same month, the month you're looking at, to the same month last year. It gets rid of that seasonality effect and kind of gives you a sense of the trend. So that's what I'll be doing in all my stats here. That's what we do in our reports. Well, if you look, again, you guys had a pretty good January too, particularly condos. I have to say, condos have been hit by coronavirus a lot harder than single family homes in most parts of the state, but they've been absolutely on fire in your market area. And I know you've got a lot Sarasota's got a lot of up and coming projects and that were underway that I know a lot of people are excited about. So, and not only that, but it's just more and more a more affordable alternative to some of the more traditional condo high-rise locales that you might find elsewhere on the coast in the state. So it's, from what I hear, even around the country, I've started to hear people talk about Sarasota and Manatee a lot more. So that's reflected in these numbers, just how these don't look like condo numbers in most other markets in the state. I'll just tell you that. But of course, coronavirus in March and April, like I just showed you statewide, in your market area, it was pretty bad as well. Condos particularly hit hard in terms of sales in April. But May, again, started to even out a little bit. And then the last 4 months, just like the state level statistics I showed you, the last 4 months have just been incredible growth. So much so that, in fact, year to date, for single family home sales in your market area, you are up 9% year over year. So through the first 3 quarters of the year, you've actually had more homes go under contract than you did last year. And that's pretty incredible at this juncture. What's more incredible is that the same goes for your condo market, because statewide, we are actually still underwater in terms of sales versus last year for condos and townhouses. So what's driving all of this? Obviously, we had a delayed spring buying season, so there's some pent-up demand there. People who ordinarily would have purchased during that time hopped onto the fence while you guys were all trying to figure out how to keep doing your jobs under the new conditions we had to work under, and market properties, and everyone else, waited until they felt like maybe, they could get back into the market and start looking around and shopping for a home. That's the big thing, is probably that pent up demand. We've definitely had a lot of that, but there's just something else here that's really fueling the demand for homes right now, and that would be interest rates. This is the 30-year fixed mortgage rate going back to about 1972, which is as far back as this data set goes. It's collected by Freddie Mac, who surveys mortgage originators every week and has been doing it since 1972. And they put together a national average for the 30-year fixed. And it just seems like over the last 2 years, we just keep hitting record lows, it seems like, every week. I'm always hesitant to say we're at a record low because I can almost guarantee that the following week we will be at a new record low. So that's been really incredible. But I do have to say it right now, we are at a record low. We're sub 3% average mortgage rate across the entire U.S. Only times it's been even close to this, and I'll touch on this again later, were actually during the lead up to this, to where we're at right now, after the Great Recession. We've gotten pretty low into the lower threes a couple times, but and a lot of homes sold at those 2 points, but we haven't seen anything like this. Now the 10-year Treasury rate, which I've superimposed here. So these are government, Treasury bonds that they sell to fund the debt. The 10-year Treasury is pretty much the traded security that is closest to what the 30-year fixed mortgage rate is in terms of a substitute. There's more risk if you're an investor and you buy a mortgage, invest in a mortgage, because the borrower may not be able to pay back, and we might have a foreclosure situation or something of that nature. So because there's more risk involved in mortgages, that's why the rate is higher, because it gives the investor a higher yield as compensation for that risk, whereas the government's likely of defaulting on your 10-year Treasury is virtually nothing. So if you study this comparison, though, over time, you usually find that it's about 1 2/3 to 2 points difference at any given time between these two rates. But as of late, it's been over 2%. That tells me that we actually have even a little bit more room to run downward with the 30-year fixed mortgage, depending on what the bonds do. The bonds are going to be little volatile over the next few weeks, I would imagine, given the political situation in the country and the uncertainty that comes with that for the economy. But still, there's room for this thing to go down more. So just keep that in mind. Now what I'm going to show you is this top chart is median sale price that we calculate each month. Our data go back to 2008. For single family and condos, this is statewide, but it doesn't really matter. This has been the pattern pretty much throughout the state. And you can see that apart from the seasonal impact of every year, we kind of see a hump in the price towards the summer every year. Apart from that, if you actually looked at this year over year, you'd find that our median sale price has been essentially growing since 2011 every month without pausing. But for a lot of home buyers, what's more important than the actual value of the home in terms of whether they can pay for it is, what's more important is, can I afford my monthly payment? And that's where we've actually seen a different trend over the last couple of years. So while prices are going up for single family homes, an estimated monthly mortgage payment on the median priced home, and based on those Freddie Mac numbers I just showed you, if we just do a quick calculation of your monthly payment each month, based on those changing rates and changing prices, you'd find that the typical monthly payment for the typically median priced home is actually going down largely over the last 2 years. And the same goes in the condo market. So that's led to greater affordability. That's why we actually had a pretty darn good sales year last year, and this year, despite all of the hurdles we've had to overcome, the market is just on fire right now. The other thing that is starting to drive a lot of our demand are the millennials, who we've been talking about and complaining about for years, but while we've been doing that, they've grown up right under our noses, and now the oldest millennials are going into their 40s, and this peak here where there's quite a large number of millennials is just about into their 30s. So basically, we're talking about getting into their prime home buying years right now. So there is a ton of demand and I'm sure all of you are aware of it, for starter homes right now, because a lot of these millennials are finally pairing up and starting families later than previous generations did, but they are doing it. So that's putting a lot of pressure, particularly on the more affordable end of the pricing spectrum, and in particular on single family homes. They were looking for space for growing families even before we had the COVID situation, where people might just want a bigger house overall because they're sick of being confined into a small space, or they might need extra space for a home office if they're going to telecommute. So on top of that, we've got millennials having families now. So that's a huge factor in the housing market. Just moving on to closed sales. Obviously, closed sales mirror new pending sales, but they are delayed by a month or two for the time of between the contract and the closing. But we saw similar numbers here. Just the last 3 months of closed sales have been quite good in Sarasota and Manatee. So you guys have a pretty darn healthy market. And in fact, for closed sales, you are now up year over year by 1.5%, and that will just continue to rise as we go towards the end of the year. I should mention I'll also provide the association with these slides to distribute to you if you wish to have them, so you don't need to take pictures from your desk, or if that's what you're doing. So here's closed sales for the state. The same kind of chart I showed you for new pending sales, basically telling you the same thing here, is that sales have been good. For condos on a statewide basis, we're still, not back to where we were last year in terms of number of sales, but for single family homes, we are now above statewide as well compared to last year at this time. So that's the demand side of things. We know there's a lot of demand out there. Some of that might burn off eventually because, as I said, we have some pent up demand, and we've probably, are getting close to using some of that, a lot of that up. But with, again, the generational shift I just showed you and mortgage rates being as crazy low as they are, I think we just still have a lot of demand to burn. So the question is, do we have the supply to accommodate it? Well, new listings was the one of the other things we started looking at the beginning of the coronavirus issue in March. And new listings actually didn't slow down till the end of March, unlike new pending sales, which stopped immediately. I think it took a while for potential sellers to change their plans, but they eventually did, and they really dropped a lot at the last week of March. But that's why March doesn't look so bad. But in April, they really fell through the floor. Although they did start rebounding about when new pending sales did. So the first half of April, really bad for new listings, but then they gradually started to come back. Not as fast as new pending sales though. But the last 4 months, I guess it's a good thing you're with as many condos as you're selling, you've got a lot of new listings coming onto the market too on that side of the market, but we're not seeing what we need to see with single family homes. But you're not alone. A lot of the state's data looks like this. Even being up 22% year over year for new listings in September, well, we don't normally have a lot of new listings in September anyway, but that is somewhat promising. But just the sheer amount of sales we're doing, this isn't enough, to be honest. We actually need more new listings. And for the year, I should mention, we are actually down on single family listings still in your market area by a little over 1%. But I expect if we have another month like we did in September, that'll change. But new listings, same kind of chart here. The actual drop in new listings was not as severe as what we saw with Irma in 2017, but it was still pretty bad. But as you can see, since then, new listings are kind of on track with where they usually are. And last or a couple months ago, they were a little bit higher than usual. But overall, you can see it's not matching the performance of what our sales are doing. So very early on in the pandemic, looking at some of this early data on those stats I just showed you, and talking to other economists and my fellow research staff here in Orlando, I think it became apparent that this was a pretty simple economics 101 type problem here that we had in terms of determining what's going to happen to home prices. The law of supply and the law of demand, if you ever took an economics course, it's one of the first things you learn, and how those two things together determine prices. By itself, falling demand, if you ignore whatever's happening on the supply side, falling demand in isolation always reduces the number of sales of a good or a service or whatever you're selling. So if demand goes down, it reduces the number of sales in the market. And at the same time, that's going to put downward pressure on prices. There's less desire for homes. Not only are people going to buy fewer homes, they're going to not want to pay as much for them either. On the other hand, if you ignore what's going on the demand side, and assume that stays the same, and you just look at supply, when supply goes down, and that's represented by us not having a reduced number of new listings and a reduced inventory of homes on the market. Not to mention the builders kind of had to stop doing anything for a little while. When you got that, that reduces the number of sales too, because there's less supply coming to the market, less homes being listed. But that puts upward pressure on prices because homes are suddenly more scarce than they were. So if the demand level is the same as it was before and there's fewer homes now, then there's more competition and more bidding wars for them. So you got to combine these two things together. So they both reduce sales. So we knew we were going to take a big hit in sales. But the question was, is supply going to fall more than demand or vice versa? Because that's going to determine where prices go. And our early data kind of told us, well, they're both falling about the same rate, so we don't expect prices to go anywhere. But since then, demand has recovered much faster and more strongly, as I just said, than supply has. So as a result, prices have really continued to rise, especially in the last couple of months. So I already talked about this, but demand for this time of year might be a little less than normal, the regular demand that we would normally have. but pent-up demand is more than compensating. I've actually probably going to amend that statement just to say that the low interest rates right now might even mean that if we got rid of that pent-up demand, the people who would have bought anyway in the spring, I still think we'd probably be performing above where we usually do. Eventually, though, as I said, we might lose some of that pent-up demand, and we might need to, we might have some moderation, but it's not going to take us into negative territory in terms of sales growth. It'll just be a not quite as hot market. But as I was saying, prices are really being driven up because the appetite of buyers for homes right now is just greatly exceeding how much we're seeing come to market. And especially in the last 3 months, we've had double-digit median sale price growth in your market area in several instances. And for the year, we were up about 8.1% in single family and 8.4% for condos in terms of median sale prices for the year. So along with the really good sales numbers and the price appreciation, or some of that median sale price number also has to do with what kind of homes are selling as opposed to normal too. If you're comparing this year to last year, maybe we are selling higher quality or larger homes or whatever. But so some of that's always going to affect a median sale price comparison. But by and large, we know that properties are appreciated. So you combine sales and prices together, and you get dollar volume, which translates most directly into your incomes. And you can see that the last 3 months have just been ridiculously good compared to last year. And we are up on the single family side, 12.4% in dollar volume versus last year in Sarasota Manatee single family, and over 20% on the condo and townhouse side. So, like I already talked about new listings a little bit and how they're just kind of keeping pace, maybe doing a little bit better than they did last year, but we've got an inventory problem. We had one even before the coronavirus crisis. This is building permits for single family and multifamily units. I've just stacked them, so it's the top line here is basically the number of units permitted each quarter and the seasonally adjusted annual rate in Florida going back to 1988. And what's very evident from the beginning is this huge peak in the middle of the chart that is the lead up to the housing crash last decade, and of course the fall and the recovery after that. I'm going to throw a dotted line in here that kind of mimics what Florida's population growth was over this period. It used to be, for 3 or 4 decades straight, basically since mosquito control and air conditioning were invented, Florida's been almost guaranteed to have 2% growth every year in terms of population, which is just astounding growth, of course. But that changed after the downturn. Ever since then, we've actually been between 1% and 2% growth every year. We've never gotten back to 2% since then. 1%, 2% of the third largest state in the country is still a heck of a lot of people every year. But what I've thrown this in there just to show you is, given the rate of population growth, suddenly we had all this extra housing that we didn't actually have people to buy. And that all came to a head at some point when the flippers stopped flipping when they realized they were holding the bag. And so there was a huge surplus of housing I've kind of encapsulated here in this orange triangle kind of thing. But after that, we actually stopped building. A lot of builders went out of business. We lost a lot of small builders, and the builders that remained were a lot more conservative this past housing cycle. To the point that we more than made up for that surplus we created in the early 2000s pretty early on. By 2012 or 2013, I think we had absorbed all that housing. So what we're left with here is a period of years where, yes, every year we build more, but there's a period of years there where we're just not building enough, and that induced a housing shortage. 3 or 4 or 5 years ago, we started to see it. You can kind of see it reflected in construction employment too, how, after the Great Recession, we lost almost, I think, 45% of our construction jobs. And we've never even gotten all the way back there on that. So building continues to be slow. I'll hop back here for a second. Building continues to be slow. This is a nationwide problem, not just here in Florida, but everywhere. In fact, Florida has done better than a lot of states, but the problem is that we tend to grow more than a lot of states, so we have to build more by necessity compared to a lot of other states. But all kinds of issues are hitting the builders. The builders are generally, though, building larger homes, upper tier homes, and lots of multifamily when, as I just said, those millennials are looking for those single family starter homes. There's all kinds of normal issues that builders face that are kind of keeping them from building those. The main reason they're not building them is because they're not profitable right now, given many factors. One being land use regulations, always an issue with the builders. Keeping them from being able to do that efficiently. You've got land issues in different parts of the state. I mean, we still have a lot of land in Florida, but not every part of Florida has that situation. Much of the South Florida Metroplex is trapped between the Atlantic Ocean and the Everglades and has nowhere left to build. That's why prices are so high in Miami-Dade and Broward County compared to most other places in the state. There's always that. The labor, as you can see in this chart, is an issue. We need to build a lot of housing, but we have not recovered all of the jobs we even had before, and now our population's much bigger. And part of that is immigration. After this crash, a lot of workers left and never came back to the U.S. And the builders and people in contractors I talk to, just no matter where I am in the state, just say, there's just not a lot of American kids interested in doing these jobs. And not only that, but when we lost all those workers here in 2006 through 2010, we kind of lost an elder generation of construction workers who would have otherwise, in another situation, been the people who mentored and trained the next generation. So we lost a lot of our training capacity as well. So particularly skilled labor construction workers we're suffering a shortage of those by a lot. So that's made it more expensive to build and harder to get talent to do it. And the trade wars we've been engaged in over the last couple of years have hit lumber prices pretty hard. I think early on in the pandemic, the price of lumber, in fact, tripled for a brief period of time. Which really sent the building community into chaos for a little while. Not as much of an issue in Florida because we have to build so much stuff out of concrete, but we still use a lot of wood in our construction. So there's been a lot of fluctuations there. So all of those factors are contributing to it. And none of them are going to get better necessarily overnight. At least most of them won't. So the builders are going to continue to increase building. It's just not going to be very fast. So what I'm telling you, long story short, is that the shortage is here for a while. Now, on the existing home side, again, we can get supply from the builders. In the long run, that's what we need to satisfy the shortage. But we also have, lots of people who we would hope could list more right now, but aren't. Over time, the length of time people in Florida stay in their homes has increased over the last several years. And it's about 10 years now. So the typical homeowner in Florida has lived in his or her home for 10 years. Initially, we thought it was rising because so many people were underwater. In 2006, when people typically stayed in their homes for only 7 years, and that started to rise, we thought, well, everyone's homes are underwater right now because of the foreclosure crisis and the Great Recession. In fact, at one point in 2010, over half of Florida's first lien mortgages were underwater on underwater properties. So they were negative equity properties. I think nationally, the number only got as high as 30%. So Florida was in pretty bad shape. We don't really need to revisit that time too much right now, but just look at how much we've improved since then, where the number is less than 5% now. But that's the problem. If you go back and look, I'll go back one slide. By 2015, 2016, underwater mortgages weren't a problem anymore. And yet the length of time people were staying in their homes continued to go up. So other theory we had is, well, it's those interest rates. I'm showing you the same chart as before, because we had those lengthy periods of time where at those times in late 2012 and late 2016, the interest rate was so low that fueled a lot of demand and a lot of buying then. We actually sold way too many. Well, we sold a lot of homes over the past decade, and now we've got people locked into these ultra low rates. We really had to wait for a time until you could get a significantly better rate than that to unlock a lot of these buyers. But it's still not happening to a huge degree, although I think it might be starting to. As I showed you, the new listings were up somewhat. But that's not a panacea for our problem, because as all of you know, probably 70% of sellers are also buyers. So that doesn't solve our problem of creating new inventory or new supply in the long run, because anyone who sells is just going to absorb another home when they buy. So as a result, if you look at inventory was already declining year over year pretty significantly over the last several years already. In January and February, single-family home listings in your market area were already down 20% compared to January of 2019. But it's really worsened since the rebound in the pandemic into the current situation we have, where we are just seeing so many sales that new listings cannot catch up. And so as of the end of September in your market, we're down 38% in terms of single family home listings, which is pretty close to the statewide number. We have counties that are down to 1 month's supply of inventory, in many parts of the state, in fact, particularly in just north of the Bay from you guys in the Tampa area, in Pasco County. We've got just ridiculously low month supply up there. And here's what it kind of looks like at a statewide level. This would actually look even worse if I pulled condos out of it, but just inventory is much less than it typically would be right now. I guess if you're down 38% inventory, that means you still have 62% of your inventory left. So I guess that's the silver lining. There are still homes to sell, but there might be something about some of those that keep them from selling. But it's just not a tenable situation. If this continues, it's going to drive up prices even more, and a lot of us thought prices couldn't even get that much higher. So eventually, that's going to outweigh the benefits we're getting from the low interest rates. The rising prices will increase the effective monthly cost of housing at some point. So just to turn the corner there, that's kind of the situation throughout much of the state right now. And your market area doesn't seem to be too much different. So I right now, that's the thing I'm watching the most closely. If I go back one slide, I apologize, I keep going back, but I should make the point. You can see the slope of the inventory falling. It was really bad from May to June. The end of May to the end of June, we lost a ton of inventory. At least the rate is slowing down, so the curve is getting less steep from month to month. That's a good sign. It's not going to fix our problem, but at least it's not getting any worse. That's an important thing to keep in mind, because that's what I'm looking at every month, is to see how much worse it gets and if it starts to accelerate again. Beyond that, just more broadly for the economy and particularly for housing, we've got, I'm keeping my eye on the post-election monetary policy and fiscal stimulus decisions that the government's going to make. And of course, that's really going to be dependent on how these races shake out that have not yet been resolved as of yet for president and for Senate. Well, the Senate's pretty much a done deal for Republicans, but there could be significant differences in how the fiscal any potential fiscal stimulus is distributed and when. The stimulus is important because, well, let me demonstrate by making a comparison between our recession this year and the one we had in March of 2000s, well, in the late 2000s, early 2010s. I tried to find the point at which Florida's overall employment level peaked before the Great Recession, and then the month where it completely hit bottom. And it turns out that's March 2007 where it peaked, and January 2010 where it hit bottom. So that's the biggest range of decline you'd see in jobs during the Great Recession, an almost 3-year period. And during that time, we lost 11.5% of our payroll jobs throughout Florida, a significantly huge number. And that's, of course, on top of people who were already unemployed. So it's not just that we had 11.5% unemployment. That's tacked on to the unemployment that we naturally always have. Construction, as I just talked about, a significant hit. There was the industry sector hit the hardest clearly by the downturn. Real estate and rental and leasing, I'm only going to talk about this just to say you guys aren't included in that because you're self-employed, and this is only if you're on a company payroll. So most of you don't. So this isn't a 15.6% decline in brokers and agents necessarily, but it does include property. A lot of property management employees, maybe office jobs and corporate jobs, and it also includes car rentals and things like that. But, government and public education was the only thing that really didn't seem to fall that much during this time period. But the caveat there is that the government usually has an echo effect. So after the tax base, literally got slammed by the falling housing prices, and property taxes and sales taxes declined, we had a lot of government layoffs at the local level, teachers, firemen, policemen, and state level government layoffs that kind of happened mostly after January 2010. So there's always a delayed effect there. The only large sector that was up was healthcare, because I guess you still need healthcare even during a Great Recession. But I'm going to compare that now with what we saw from February to April of this year. And so as opposed to a 3-year period, now we're looking at a 2-month change in employment. And we're talking a 13% drop in employment in Florida, bigger than the Great Recession. Construction, oddly enough, only down 4%. That just goes to show you how much demand there is for housing. These two numbers couldn't be any different. Other services, that includes stuff like nail salons, shops you might go to. People didn't want to go into stores. Stores, were shut down for a while, or did not want to open. Retail was actually hit pretty hard in both cases, and about by the same amount. That's a huge chunk of jobs, but clearly leisure and hospitality, that includes our hotels, our tourism attractions, and the largest chunk of it is our restaurants all throughout the state, restaurants and bars. So you can see that even though overall we had a similar drop in the level of employment, the sectors that have been hit hard in the pandemic recession are completely different. We even had healthcare fall by 9%. In fact, we have 2 large healthcare providers that kind of serve Orlando, Advent Health and Orlando Health. And my doctor was an Orlando Health physician, and he actually lost his job because he was presumably not one of the profitable doctors. So right at the beginning of the coronavirus pandemic, my doctor was canned, along with the 2 other doctors in his office. He was a really good doctor and spent a lot of time with me. That's probably why he didn't, see enough patients and make enough revenue. You don't normally expect healthcare to go down, especially in Florida, but it did. That said, we've had a little bit of a recovery. Now I'm going to compare February to July, so 3 months after April, and you can see it's a lot less severe of a drop, only 6.7%, which means out of that 13% we lost, we actually got quite a number of those jobs back. A lot of these job losses were just simply temporary layoffs or whatever employers had to do, because we're all frozen, not knowing what to do, where this whole coronavirus thing is going to go. What's our plan for fighting it? We still had to learn a lot about the virus. So a lot of those jobs were only ever going to be temporary layoffs. And so we got a lot of those back. But if you translate even that into the number of jobs that translates into, so each of these sectors has different numbers of employees, or they're different sizes. So just to give you a sense of how many employees lost their jobs between February and July, well, we were down a net 605,900 jobs as of the July numbers out of the Bureau of Labor Statistics. And almost half of those were leisure and hospitality, a huge chunk of which are those restaurant jobs and bar jobs and Disney World jobs, beach-oriented jobs, all kinds of stuff like that is in there. Professional and business services, which does include a lot of our high-paying white-collar jobs, was down significantly too in terms of number, but that's actually, I dug deeper into the data, and that actually happened to be more of the blue-collar side of professional business services, and especially services that service office buildings, like cleaners and pest control, all kinds of landscaping, all kinds of jobs like that. You saw lots of layoffs as we emptied our offices for a long time. Now I'm going to show you basically the same thing, but this is the difference between February and September. And what you're going to immediately notice is, so yeah, we had a lot of progress between April and July, but since July, not a lot has changed. We've gotten, overall 80,000 or so jobs back, or 65,000 or so. But we've still got a huge problem with this leisure and hospitality employment, particularly, and professional and business services. If you look overall at employment for Florida and the US, we've actually not seen as big of a percentage drop as the US overall. We've actually one reason is we've just been a powerhouse at creating jobs, and our Florida economy had a lot of momentum going into this. But you can see, if I zoom in here on Florida, the bounce back in jobs was pretty quick those first 2 months, but it's been a lot slower since then. And problem here is that the longer people are detached from the job they had, well, the more likely that's an indicator that the business is not doing well, or at least not well enough to bring the workers back. And so what we're concerned about in the economics community is that we're going to start to see some businesses start to fail at greater rates. And we're going to start to see more permanent job losses, permanent destruction of jobs that go along with that. That's why there's such a debate about stimulus right now. If you're following what Congress is up to and the White House has been up to leading into the election, when they eventually decided they weren't going to do another round of stimulus for either the business side or the consumer side. So that's kind of what I'm keeping an eye on now, and whether we get the Senate, controlled by Republicans leading up to the election, did not want to do any additional stimulus right now, whereas the White House and the House of Representatives were trying to work on a deal. But a lot of senators were not into that, or at least that's what they said. But as soon as I think they determined that they were going to win the Senate, the Republican Senate is now saying that, I guess, we might be up for a little bit of stimulus. So they're starting to send some signals that we might get some of that. The debate largely rests on, do we continue to give supplemental unemployment benefits beyond what people get from their state unemployment systems? Because that's what we were doing initially with the CARES Act, and that allowed a lot of people to get by, but that money ran out a while back, and now I think there's a lot of households out there that are increasingly going to see some stress. That said, at the same time, at the state level, and then later at the national level, we've had a renter eviction moratorium, which has really distorted our rental market. And it might be responsible for a lot, depending on how many people are taking advantage of it, And I don't mean that in a good way. I mean, you can pay your rent, but you're not because you don't have to, kind of thing. People have squirreled a lot of money away, and that might have gotten them by for a while, but they're going to have to pay the piper eventually. More importantly, landlords, they're not all large, monolithic companies that own tons of properties that have a lot of cash in reserve. A lot of them are mom and pops. So some of you may be landlords. Where are you supposed to get your income from? And that's a huge problem for us. And I know NAR is hard at work, trying to work with Congress and the White House on a solution ahead of the election. Now that's kind of in limbo, I guess, for a little bit until we figure out where things land. But at some point, we're going to have to lift this moratorium. It's supposed to end at the end of the year, but it's got to be lifted. And if they want to supplement incomes, they can give renters income, and then that's fine. But then they can pay the rent with some of the money that we're subsidizing them with, instead of not having to do that. So that's really just important for the health of the housing market. I'm really a lot more concerned with the renter side than the homeownership side right now. Like I just showed you, the vast majority of job losses we've seen are lower wage jobs that are typically held by renters. So that eventually can spill over into the into the side of the property market that deals with home ownership, just because in many cases single family homes and condos are can be one or the other. They can be rentals or single family homes. So the distortion in the rental market can really hurt the real estate market overall. So keeping my eye on that. Mortgage forbearance is actually, I get more questions about mortgage forbearance and that issue, and I just don't see a huge issue with that right now. I can't imagine a lot of these forbearance plans are really front loaded such that when the forbearance ends, they have to pay all of it back. I think the lenders, for the most part, we need to get better data on it. We don't have great data on how these plans are structured. We have a sense of how many are out there. We just don't know how are these restructured so that you can easily make the payment back over time and not all at once. But even so, again, homeowners have not largely been as affected by job losses, although there are homeowners who have lost their jobs, of course, but they haven't been quite as affected. But the other reason I'm not quite so worried about us having another wave of foreclosures is that this time around, like I showed you, we don't have anyone with negative equity right now, and we have a scarcity of homes instead of an abundance of homes. So rather than having to do a short sale or be foreclosed on, you can probably sell your home for the equity right now and be just fine. So that's why I'm not concerned with seeing a huge wave of foreclosures. It's the supply of housing is in a completely opposite direction right now. It's way too little instead of way too much. That puts a floor under prices. Prices won't be able to fall if we start to see foreclosures, because there will be bidding wars for them, and most of them won't even get to the foreclosure. Just look here at inventory going back to 2008, and I suspect that wasn't even our highest point for inventory back in 2008, but clearly we've got a heck of a lot less inventory now than we did back then, and we've got a lot more people in Florida now too. Other thing I've got my eye on, especially in your market area, you tend to have a lot of activity out of Canada, Germany, France, the UK especially, some activity out of Latin America and the Caribbean, and China. That's a huge important source of business for many of you, I know. And so I'm keeping my eye on it, but what can I say right now other than you can't go to any of these places for the most part, and none of the people there can come here. So we've just got to push our way through the pandemic and hopefully get some therapeutics and a vaccine up and running in the coming year, because that's really hurting our international sales right now. And so finally, the last thing is the pandemic. No one, I'm not an epidemiologist. I've tried to become an amateur epidemiologist and predict where the pandemic's going, but it's pretty difficult to do. All I can say is that we are here in Florida right now, we've been experiencing for the last few weeks increasingly rising number of cases. The upper Midwest is seeing a much faster growth, and clearly parts of this country are about to go through a very large wave of the coronavirus. It remains to be seen how big our wave might be, but here in Florida. But as for right now, we definitely have a concerning trend going on, and hopefully, we can get to the vaccine that time next year when we get one. Hopefully, we can only deal with this one last wave, and hopefully, this one doesn't become very big at all. But that's everything really. We can't completely fix the economy. Look at all those jobs that are missing. We can't fix the economy until we've taken care of this pandemic and/or it's run its course. So just something, unfortunately, we have to keep watching. But with that, I am going to stop here